Hello, everyone, and welcome to the 2025 Economic Update and Investment Forecast. I'm fortunate today to be joined by our Chief Investment Officer, PJ Williams. Hi, PJ. Dax Dixon, Wealth Advisor in our Chapel Hill office and also a member of our Investment Committee, and Jason Croy, Wealth Advisor in our Greensboro office and also a member of our Investment Committee. Welcome, gentlemen.
Thank you.
So we have a lot to cover today, and I'm just going to pull up our agenda, which starts with a recap of 2024. We all know what happened. We had a lot of events occurring in 2024, a lot on the geopolitical and domestic political front, but we're going to focus specifically on the impact on markets and the economy. We're then going to move to potentially good trends or tailwinds for the investment markets next year. We're also going to talk about some of the potential headwinds. And then, unfortunately, we have some wild cards to cover, more than is typical generally. And we will conclude with our advice to our clients and broader audience in terms of how to navigate these uncharted waters. So let's get started. So PJ, if you don't mind, please give us a recap of 2024.
Yeah, so quickly before we get into the numbers here, I think we want to go back to the end of 2023 and really look at or think back to what were we looking forward to when we went into 2024? What was investors expecting and what were they really focused on? I think there's a number of key catalysts that investors were looking at. We were looking at what the Fed decisions were going to be during 2024. What was inflation going to trend towards? Was it going to continue trending down? Or were we going to get an uptick, a reignition of inflation? And what was going to be the development within artificial intelligence or AI? Could corporate earnings growth continue to be positive and strong? And really what we're going to see on the geopolitical landscape. And then one of the bigger items domestically here in the US was the election in November of 2024. At that time, back at the end of 23, most were expecting a close election when we were headed into 2024. And so then what played out for each of those areas? With the Fed, investors expected that we were going to see cuts during the first quarter or first half of the year. The first rate cut did not come until September of 24. On the inflation front, we'd made great progress from 2022 to end of 23. We went from 6.5% December 22 down to just over 3% in December of 23. What would happen with that trend? It did continue. We got below 3%. We got down to the mid twos, but then we did have a reignition the last couple of months, and we'll talk about that later, but we're sitting at 2.9% on headline CPI right now. What was going to happen on the AI front? We all knew ChatGPT, which was released in December of 22, had made great progress and continues to make great progress, which has improved productivity and efficiency. But what did that mean for the labor markets? What did that mean for tech stocks? And so we saw that play out. And obviously, we saw just this last week, the release of DeepSeek R1, a new kind of AI from a Chinese company. And that had an impact on the markets. And we'll talk about that later as well. On the corporate earnings front, we continue to see strong and robust corporate earnings. In Q4, FactSet is projecting north of 10% year-over-year corporate earnings growth, so very strong. And on the political landscape, or the geopolitical landscape, I should say, we saw the Ukraine and Russia war continue. We saw the Israeli-Gaza war continue, although there has been progress here recently. We saw U.S. and China's relationship go up and down. Now with the new administration, we will talk about later what that means for going forward for U.S.-China relations. And then we got to talk about the election. As we got to mid-year, towards the end of June, we had the debate between President Biden and the Republican nominee Trump. That did not go well for Biden. Obviously, he dropped out shortly thereafter. And really, that last couple months leading up to the election, we saw a period where expectation from the markets might have been that Trump had a nice lead and was going to win. What we saw in the stock space within sectors is that you saw healthcare, which wasn't expected to do maybe as well under Trump, experienced a decline, while financials, which would benefit from deregulation, had a very strong couple of months leading up to the election. So again, a lot occurred that drove market performance. And on this slide, we're really going to talk about the numbers to show what a great year 24 was.
Yeah, so I'll pick up with that. PJ, just you've had a few minutes to look at the data on the slide. I'll kind of orient us a little bit about what we're looking at. So each of these colored boxes represent one of the major asset classes that a lot of investors may choose to invest in. Across the top of the slide, you can see different calendar years. And if you look at the far right, you can see last year's performance in 2024. Each of these boxes or each of these years are ranked from the best performing asset class at the top down to the worst performing asset class for that year at the bottom. And in 2024, you can see that green box, large cap US stocks had a phenomenal outcome, up 25%. That was on the back of a 26% return the year before that. But as you scan down that 2024 column, all of the other major asset classes had good growth, but growth that was less than half the performance of those US large companies. Small companies in the US are up 11.5, and you can skim down and look at some of the other asset classes. And so it was another year where a lot of those big companies in the US market that really dominate some of the size of the US market continue to control performance of what the stock indexes did. And to the extent that anybody was not concentrated in their portfolio in the US large cap stocks or in those handful of high growth businesses, performance looked a lot different than some of the headline numbers you may have seen with the S&P 500 being up 25%. You see that white box in the middle, that is an asset allocation model. It's put together by JP Morgan. This is a JP Morgan illustration, and it's just their version of a 60-40 style diversified portfolio. So 60% stocks, roughly 40% in non-stocks. And what this illustrates is the benefit of being in a diversified allocation. That white box is never at the top of a column. It's also never at the bottom of a column. Over time, it continues to just cut through the middle and shave off a lot of the volatility that gets experienced by any individual asset class in any given year. Last year, a typical diversified allocation ended up around 10%. That's where JP Morgan's strategy ended the year. And that's a strategy based purely on indexes. There's no management costs, there's no investment costs underlying that. But any diversified allocation that is going to shift you away from being concentrated in a few large companies is going to ended up with very good returns, but not nearly keeping up with the headlines that we saw from some of the bigger technology firms in our country. And so we just wanted to level set about how performance shook out last year, because it was a very good year for most of our client portfolios. I hope you feel that to the extent that you're more aggressively positioned than a 60-40, you had a little bit better returns most likely. The more conservative strategies, slightly lower returns, but a very good year overall. And we continue to think that being in a diversified allocation is going to give big benefits in the years ahead. And we'll talk about what we're expecting going forward, but hopefully that allocation model can help cut through any volatility that may come up.
So Jason, I have a quick question for you.
Yeah.
So, this time last year, we were talking a lot about the largest names within the US really dominating returns in 2023. And based on your comments, it sounded like, that theme sort of continued into 2024. Even if you kind of look under the hood within the large cap space, I guess, what are we seeing on the investment committee? Is there any signs of maybe that changing even later in 2024?
There's definitely potential. Something we're going to circle back to later in the presentation is the idea of valuations. Valuations on a lot of those businesses have gotten pretty stretched. And so while they have had great performance the last couple of years, really riding this theme that PJ laid out earlier of artificial intelligence and what that could mean for future productivity and future growth, there's definitely a risk embedded in it as their price has gone up so much at such a faster pace than what their earnings have grown. And so these are incredibly profitable businesses. They generate tremendous levels of cash flow, but their valuations have gotten fairly stretched. And so as we think about putting portfolios together for our clients, we want to be mindful of risk that is embedded in being concentrated in just a few names.
Yeah, and Jason, that's a really good point, is particularly for our clients who are primarily in retirement mode. We don't have the same exposure to large cap stocks or those Mag 7 stocks as the overall S&P does, which is close to 30%. We're probably more like 20%, and that's to reduce volatility. You guys may remember when tech was down, it was down as much as 70% on the NASDAQ. So we don't want that kind of volatility when you're in preservation mode. If you're 20 years old, that might be a different thing. You don't plan to access these funds, but we definitely don't want our clients in retirement mode who are actually living off of their portfolio to experience that kind of volatility. Yet we still want some exposure there because you need the returns for growth.
Yeah, those are great comments. I agree. We continue to focus on high quality businesses that have reasonable valuations, and we're likely to always kind of tilt in that direction. And so, to your point, we're never going to be as concentrated as what the S&P 500 is and some of those larger companies. But as you can see on the screen again, that asset allocation portfolio does a great job of cutting through the waves no matter what the market and economic outcome was in any particular year. We think that's going to be true later this year and going forward.
Yeah, I can even recall in 2022 when every asset class was down except some alternative investments. Those were the assets we went to fund our clients' living expenses. So being diversified has its advantages. You just never know when you're going to have to invoke it, right?
Right.
Another big theme for us is inflation. And PJ, why don't you talk a little bit about where we are on the inflation front?
Yeah, I think we can all say that inflation played a big role in the outcome of the election. I mean, it was just one factor, but it's really at the front of everybody's mind. You see it every time you go to the grocery store, you feel it as you're living your daily life with the expenses across the board that in many areas have been more expensive in recent years coming out of COVID. What this chart's showing is going back to 1990, how have both headline CPI or headline inflation known as CPI and core inflation progressed. Core inflation's excluding the volatile items such as energy and food. And so CPI is the blue line and core inflation is the yellow line. And the red shaded areas are recessions. And you can see that for a lot of the period, we've kind of been in that 2.5% to 3.5% range. Barely gotten outside of it back in the early 90s, we did. But obviously, I think everybody in more recent times remembers what happened during COVID when we had headline CPI spike to 9.1% back in June of 22. Core inflation reached 6.6% back in September of 22. And we've made material progress since then, with, again, inflation dropping back below 3% on headline CPI to 2.9%, core inflation dropping now down to 3.2%. Our concern on this slide, though, is when you look at that kind of bottoming out of CPI, we've had an uptick here the last couple months. We bottomed out at 2.4% last September. And so going from 2.4% now back to 2.9%, that's something that's a concern. It's a concern for the Fed. We've talked about this last year at our economic update that if you go back to the late 70s, early 80s, but in the late 70s, we had that kind of reignition of inflation where the Fed cut maybe too fast, too soon. And I think Jay Powell and the Fed are very cognizant of that and wanting to avoid having inflation reignite. And so that's why we may have seen the Fed pause their rate cuts this week as we're recording this. And so again, inflation is going to be something that we're going to continue to watch as we move into 2025.
Thanks, PJ. Let's hope that we don't enter another period of Twin Peaks on inflation. But again, the Fed met this week and decided not to lower rates again. And so they're concerned as well. Let's shift our attention now to 2025, where we're going to talk about some of the good, the bad, and the wild cards. As I alluded before, we have a few more wild cards than are typical this year, and want to be mindful and let you guys know that we're highly vigilant on some of these wild cards and would adjust our allocations accordingly if necessary. Before we get started on that, I want to draw your attention to this particular chart. On the left of the gray bar, you will see the Democrats on the bottom, which are the blue line, and the Republicans on the red. And you can see when Trump took office in 2017, consumer sentiment among Republicans went through the roof. And as you can see in 2021, when Biden took office, Democratic consumer sentiment went through the roof. And so that's not atypical. This slide is here simply to demonstrate that whether we're conscious of it or not, all of us view news through a filter of our own political biases and viewpoints. And so setting this slide up just simply to say that in the following slides, we're going to talk about some policies and how they impact the economy and markets going forward, and ask our audience to be mindful that this is not a political or partisan commentary. They're simply factual, and try to stay open-minded. As this chart shows, it's not always easy. So Dax, why don't you pick it up here with what some of the tailwinds are for the economy?
Yeah, I appreciate it, Holly. I think even though I have a Grinch over my right shoulder, I'd say I'm one of the more optimistic people about the economy, on the investment committee right now. And I think if you kind of look through at all the data, as Dennis would often say, we have seen rolling recessions really since COVID in a number of different sectors. All that said, the underlying economy still looks very strong. PJ mentioned the 10+% profit margins were expected in Q4 2024. And so that just shows the health of the market of businesses in America right now. And I think some of the euphoria we've seen in the market really leading up to the election last year was the potential for either extending the tax cuts from 2017 or even further decreasing tax rates here in the US, along with deregulation. So those industries that may experience deregulation under the incoming administration, you really started to see them do well back as early as July of 2024, kind of looking through at the probability that Trump might win the election. And finally, PJ touched on in his opening remarks, productivity continues to peak here in the US, and a lot of that's driven by some of the gains within artificial intelligence. And finally, on the labor market side, coming out of COVID, there was ample job openings out there. The labor market was extremely tight, and this could increase wage inflation. And so over the past, 3 to 6 months, we've seen that ease a little bit. I still think it's a pretty good market for anyone looking for a job. There's plenty of job openings, but it's just less tight than it was maybe in 2023 or early 2024.
Well, Dax, you're perfect for this next slide because I know a lot of our audience has seen the amazing gains that we've had in the market, and there's just this feeling out there that we're probably at the end of this business cycle. But if you look at this next slide, talk us through what KKR thinks.
Yeah, so KKR they're an alternative manager, but they also do macroeconomic research, and we do follow their research in our investment committee. And so every business cycle has a number of different, segments within it. So you could either start with a recovery or expansion or slowdown, but on the left side, you could see early in a cycle, you see a contraction of the economy, and then you move into recovery, and finally you see a late cycle slowdown. So all the various circle dots on the page represent different macroeconomic factors, whether that's, jobless claims or M&A volume, which is, businesses acquiring other businesses, or where the yield curve is, whether it's inverted or it's steep. And so KKR, they basically take a weighted average of these to tell us, where are we at, or try to predict where we're at in the business cycle. So there is a purple diamond kind of on the left side, right between contraction and early cycle recovery. And so what this is telling us is their indicator right now is saying, we're still fairly early on in the business cycle. And so there's still room for the economy to grow and expand. I think we're predicting maybe not some of the headline GDP growth that we saw last year, but still a healthy 2 to 3% or so in GDP growth for this year. So I think it is important, though, to differentiate that from the market, because sometimes the market can front run what's happening in the economy. But, most signs right now look fairly healthy for the U.S. economy.
So Dax, thinking of what the Fed's been saying for the last couple of years, really, they're trying to implement and achieve a soft landing. Looking at this slide, when you're seeing that purple diamond approaching the early cycle recovery, really, and we haven't had a severe recession during this period, would you say that they are on path or have already achieved a soft landing?
Yeah, I think that's a great question, PJ. And I think, I think it's to be determined. So far, so good on that front. They have been able to navigate some of the high inflation that we saw in 2022 and early 2023 without, quote unquote, breaking the economy, where we haven't seen a major recession because of, how quickly they raised interest rates over that period. However, I think right now, inflation and interest rates are sort of on a knife's edge. And so, the slide you talked about a few moments ago showed you saw a little bit of hookup of inflation kind of late 2024. So, some of the comments from Powell were, back in November, were the Fed's going to take a wait and see approach, specifically around some of the policies of the incoming administration, because they're potentially inflationary. So I think they're trying to balance keeping inflation down while also not being too restrictive on the economy at this point. I think so far so good, even at 3%. It's a little higher than what we saw in the 2010s, but I think the market and the economy has shown historically it can operate within a 2 to 3% band on an inflation. But, hopefully they'll be able to navigate that second wave of inflation if we see that kind of later this year.
Yeah, and on that front, it feels like we've had some rolling recessions in various sectors of the economy. For example, commercial real estate versus other parts, and presumably we've got some growth in those other parts. Jason, can you comment on that?
Yeah, no, I think that's spot on. I mean, KKR would even suggest that if you look at this slide, all of their economic measures are much more spread out at the moment than they have been historically when they've gone through this analysis. And so you have seen different parts of the economy, those that are more interest rate sensitive, behave differently from parts of the economy that are not as interest rate sensitive as the Fed has changed interest rate policy these past couple of years. Technology communications firms have obviously had strong growth these past couple of years. Energy companies have gone through a little bit of a dip in recovery. Financials have behaved differently than that. Healthcare was mentioned earlier, was down last year. And so you just had different experiences for different parts of the economy at different periods over the past couple of years. And so, yeah, I think that's spot on.
Made it easier for the average person when it's not the entire economy at one time going under, right?
Right.
So this has been a pretty good thing. But as you mentioned, this chart is very asynchronous. So it's not like all the indicators, which are represented by the dots, are clustered in one segment.
Yeah, and I would say one more thing, this is one illustration from one research provider about where our economy may be on this curve. No one ever knows exactly where we are in the business cycle at any point. This is just KKR's estimation of it. We thought it was a good illustration of just illustrating that the economy overall is pretty healthy. I mean, GDP was set to grow last year in 2024 at about 3%. So not too hot, not too cold. We've mentioned that inflation's come down a lot. The unemployment rate is really fairly low and has been stable for several months. And so that backdrop is very healthy for US businesses right now. And so, the next illustration we're going to show, if you think about the profitability of companies, this line shows the profit margin on companies in the S&P 500. It's got a slight trend going up and to the right. And so these are forward estimates of where profit margins may come in. Those margins, that's what the actual income of a company is relative to the revenues that they bring in. That ratio dipped a lot back in the great financial crisis in 2009, had a steady rise through the teens. And then you saw a little bit of a jump up in 2017 when corporate taxes were cut. The corporate tax rate was cut in half, essentially. Coming out of COVID, there was some growth on the back end of that. But then in 2022, when interest rates went higher, you saw profitability start to get pressured. But over the last couple of years, as inflation has come down, many companies have been able to recover. And these forward estimates are suggesting that profit margins are going to continue to grow into 2025 at a pretty healthy clip. PJ mentioned the 10% or so expectation for Q4 profit margins. They're actually running ahead of that at the moment. We're still very early in earnings season. But right now, on aggregate for the companies that have reported, they're showing profit margins of above 12%. And so that's expected to continue to increase throughout this quarter and throughout the second quarter as well. And so all that to say, we have a very positive economic backdrop right now that's allowing the consumer, the US consumer, they're working, they're making money, they're spending money. That consumption is driving GDP growth. And that consumption is also driving profitability of businesses. And so as we come into 2025, there is a very healthy momentum in the economy and in the markets that should theoretically, by these measures, be supportive of stock prices in the months ahead. There's always risk.
And I think that's going to be even boosted further potentially by AI.
Exactly. And so, so that's we start to think through what's going to drive those stock prices higher over the next decade. What's going to bring economic growth materially over the next decade. This slide shows one economic metric related to productivity. It's essentially a measure of how efficient is our economy. All the people that are working and creating economic output or economic growth, how efficiently are they able to do that? There's a lot of lines on this chart. Each line represents a different developed market. That dark blue line is the United States. And you can see prior to COVID in 2020, that gray shaded area, there were several economies that actually were more efficient than the US at producing economic growth. Coming through COVID, a lot of those countries experienced a very sharp downturn that the US was able to get through relatively unscathed on an efficiency standpoint. And so you can see that dark blue line is fairly strongly ahead of most other developed countries these past few years. And that's really what's allowed the US market to march higher and have better performance than a lot of competing indexes. We think that is, again, a healthy backdrop for businesses over the coming quarters, the next few months. But we do have to think through how is this going to continue on this pace going forward. You can see that most of these lines are very clustered together. Is the U.S. going to continue to outpace the other economies at this scale, or will there be a closing of that gap among some of these other nations? And we do think that artificial intelligence has the potential to drive that productivity over the next several years. And so that there's obviously been a lot of capital chasing that. A lot of companies related to artificial intelligence have experienced tremendous growth the past few years. A lot of our clients have had the benefit of seeing that in their portfolios to an extent through some of the funds that we use. But we also think through what are maybe second order opportunities, investment opportunities that are tied to artificial intelligence that could continue to increase productivity. We think infrastructure is one of those. So we'll show another illustration of that to get a little more granular about what that opportunity looks like.
Well, before we go to that, if I can ask Jason or PJ, on the previous slide, we kind of saw a gradual increase in profit margin really over the last couple of decades with a few air pockets of recession in there. Do you think like AI in the last couple of years has certainly driven that? But what has driven that increase in profitability of U.S. companies over the last couple of decades? And I guess what do you think are the threats potentially to the maybe some of the margins that we're seeing in the U.S. right now?
Yeah, I'll start off. I mean, I think there are a couple of possibilities there. One, we had very low inflation for the past few decades overall. And so companies did not have to worry about their production costs rising at a material rate. And so that allowed them to operate more efficiently. The other thing is just a shift in our overall economy to be more technology centric. And so any technology firms have a unique ability to scale their services, getting more and more productivity, more and more output with a similar amount of input or units going into that.
Yeah.
And so, at the cost. And so that has driven a lot of their profitability as we've shifted as an economy to be more tech centric. It's shifted sort of the data of the economy as a whole to look more profitable as well.
Yeah, we had some surprising news this past week, I guess, with a Chinese competitor coming in on the AI front, and that caused some volatility, I know, in the tech sector in the US. PJ, why don't you talk us through that event?
Yeah, so what this chart's showing is really the components that kind of go into the AI ecosystem. And so the charts kind of go on top to bottom. I'm going to approach it from a little different perspective and starting the top right. Investors, you need capital to build out this ecosystem. That might be from venture capital startups, the limited partners in those funds, or it might be from large tech companies that use their balance sheets to invest in CapEx to develop out these AI tools and to build that infrastructure network. And so three of the main components that are needed in this infrastructure are data centers, chips, and power. Those are kind of three things that we need a lot more of if you're thinking about building out what we think is the potential of AI and kind of that AI ecosystem. One fact that JP Morgan referenced in an article was that a query on ChatGPT, their large language model, the LLM, that's what you're going to hear a lot more about, but their AI system, it requires 6 to 10 times the electrical power of a Google search. And so if you think about the fact that you can now access ChatGPT and other like technologies on your phone, so we're all able to do it just like we do a Google search. It's a game changer in terms of what might be needed on the infrastructure side. I mean, we're talking hundreds of billions of dollars potentially over the next few years in building out more power. Our electricity potential and capabilities currently, a lot of it's built on fossil fuels. We've kind of moved into some other more sustainable energy sources as well. Right now, that is not enough electrical production or power generation to run these AI systems if it becomes as big as many believe it will. We need to look at other options, whether that's, again, trying to extract more fossil fuels, but there's a cost if oil prices go too low, then that disincentivizes producers from producing. And so what are some other options? Are to bring back nuclear. That's definitely gaining traction. When you think about that, it's something that, again, we've had incidents in the past which have made people wary and concerned about reintroducing nuclear, but I think it's gaining traction right now. And so that's something you're going to be watching over the coming years on how we build out this power, this green area over here on the right. In the middle are chips. That's something that everybody thinks about semiconductors or what drive technology, what's in your smartphone, what's, again, kind of the back end, the boosting that takes the power and makes things smart enough to do these types of AI tasks. And so we need to continue to advance those, but that's what people are most familiar with. On the left is really a real estate play, data centers. If you look at the last year, a couple of years, office valuations we know have plummeted. They may have bottomed out, maybe coming back a little bit in certain areas, but office has struggled. Multifamily, we've seen an oversupply in certain markets recently. Data centers have continued to do well. Again, we don't have enough of them right now based on what is needed to, again, run this massive AI platform, not only across the US, but around the world. And so, again, CapEx is needed. Recently announced Stargate project. Again, that is a joint venture created by tech companies and other investors to potentially invest upwards of 500 billion over the next few years to kind of build out this infrastructure, really focus on data centers, but other pieces of this puzzle that we're looking at of this ecosystem. But then Holly just referenced it. A Chinese competitor, DeepSeek, announced last week that the claims are that it's able to do this close to what ChatGPT can do, but with less sophisticated chips, and it costs a lot less to develop. And so what's going to be happening now and over the coming weeks, the U.S. government, U.S. tech companies that are competitors are going to be really looking into this and trying to figure out how accurate are any of these statements. Did they actually use more advanced chips than they're letting on? What was the true total cost to developing this and then to actually run it ongoing? And so I think it's a little early to make any bold predictions or claims about how this may alter the pathway that our AI systems have been on. But the one thing that's clear and that's been kind of reported widely in the news is that this might be the Sputnik moment of this AI development. If you think back to Sputnik 1, again, the first kind of abbreviated satellite to go around, artificial satellite to orbit the Earth, I think back in 1957 it may have been, the US was caught off guard by how sophisticated and advanced Russians' satellite systems were. And so this appears to have caught the US off guard in terms of how far and how advanced China's AI systems may be.
Yeah, so I'll throw in a caveat here is just like with pharmaceutical manufacturing, it takes a lot of R&D to build that first drug. And then the patent runs out and you get a lot of less expensive knockoffs. And so it's unclear how much of what has happened with DeepSeek is based on what's already been developed in the US with ChatGPT and whatnot. And then the other caveat I would throw in is that, yes, this AI needs a lot more power, but hopefully over time it could potentially become more efficient as well. So maybe it's not going to need quite as much power as it currently is predicted to take. Would you agree with that, PJ?
Yeah, I think the next few years are going to be crucial in terms of where this is headed, how far it's headed, how it becomes kind of integrated into our everyday lives. And really, what does that mean for, again, how much power, like you said, is needed, how many chips are needed, and then, again, how many data centers are needed around the country.
Yeah.
And I would just throw in, it may surprise a lot of people to know, but sleepy old utility stocks are actually one of the best performing sectors last year. They outperformed many of the technology companies actually, just on this theme that power generation is going to continue to be needed and is going to boost the profitability of those firms, even though they are a regulated industry. And I would just also say that, that artificial intelligence is one facet of infrastructure as a whole, but there's a lot of capital going into just infrastructure improvement across our country, whether it's water treatment facilities or toll roads or different categories in the infrastructure theme. We do think that is a major opportunity ahead to both diversify portfolios, but also achieve attractive returns in the years ahead. And so we're increasingly finding ways or looking for ways to add infrastructure exposure for our clients. We've had it for a number of years in a couple of our products, and we're continuing to expand that product set for all of our client strategies.
Yeah, that's a really great point because in 2022, it was those infrastructure and real asset funds that we went to fund living expenses for our clients when every other asset class was down, including public stocks and bonds.
Holly, if I could
Yeah.
jump in real quick, I think something PJ said is super important for productivity, and it's just the capital expenditures that have to go and profitability. It's the capital expenditures that have to go into these various areas to power and enable artificial intelligence. And to the extent that they're successful, I think there's a lot of investment opportunity there. And they're successful by, do we see the productivity gains from AI on the back end of this, or will capital be destroyed through this? So I think there is some execution risk to investing in these various areas, but if we're successful in doing so, and we can successfully build out the infrastructure needed to support AI development, whether that's energy or the data centers, then I think you can continue to see, the U.S. maintain high levels of profitability.
Yeah, I think that's a good point, Dax. Let's focus our attention next to the labor markets. How does all of this AI development that we're talking about impact labor, or does it?
Yeah, and so labor market trends are still positive. Again, we've been touching a lot on how resilient the U.S. economy has been. On the left here, we can look at non-farm payroll gains. On the most recent number, the print in December showed that we grew jobs 256,000 in the U.S. Expectations have been for 160,000. So again, we are continuing to, in many months, beat expectations for what people think job growth can continue to be. And so at 256, that's a very healthy job market. If you look at the left side of this, you might think, well, we've come down a lot from where we were. But you have to look at this starts in January 2021. It's missing COVID, where we had a lot of job losses. And so 21, or really 21, early 22, we are just regaining the jobs that were lost during COVID. So again, strong job growth. Unemployment ticked down to 4.1% last month. So again, that's a very healthy unemployment rate. On the right here, we're looking at JOLTS job openings. What does JOLTS stand for? Job openings and labor turnover surveys. And so this is looking at how many jobs are open in America. You can see we peaked in March 22, over 12 million. Today we're at 8 million. Again, similar to what we saw in inflation, you've seen an uptick here recently where we bottomed out a little bit, and now we're actually seeing more jobs opening. And so that shows a healthy, maybe tight labor market. But if you look under the hood a little bit more, if you looked at hires and quits, so how many people are being hired by companies, how many people are choosing to quit companies, those numbers are much lower and trending down. And so again, when you get to that point, that might indicate a looser job market, as Dax alluded to earlier, where if people are not choosing to leave their work for another one, they might not be seeing the opportunities they're looking for. And just like if hiring's slowing, companies may be reticent or hesitant to continue hiring because of what they might see out the front windshield in terms of forecasting their financial projections for the next year and choosing not to make those additional hires. So again, is this setting up for a soft landing? And that's the question. Or have we already achieved it? But again, we're definitely seeing a looser job market, but it's still strong. And that's what the Fed's looking at. They're seeing a strong labor market, and they're seeing inflation kind of trending back up. And so that, again, was support for them to pause this month and not cut rates.
Thanks, PJ. Hate to shift our attention now to some of the headwinds that we're looking at in 2025. But alas, there is no choice but to acknowledge that we have highly stretched valuations. We're at 22x forward PE versus 16x at the beginning of the first Trump term. So stocks are priced for perfection. On the next slide, we're going to talk about some different valuation metrics, but no matter how you cut it, this is an expensive market. And we all know that money is made when you buy stocks, not necessarily when you sell them. The other headwind that we have are tariffs. Trump alluded yesterday to a 25% tariff on Canada and Mexico due to migrant crossings and also fentanyl. And so we'll see what happens on that front. But clearly, tariffs are inflationary for the economy. And then finally, the Fed slowing interest rates cuts is also not exact. It doesn't promote business and growth. And so let's look at that a little bit further, if you would, Dax. Walk us through these various valuation metrics.
Thank you, Ollie. So these are various ways to value the S&P 500 in this case, and I think it's important to contextualize these. I think the most common valuation metrics is the price to earnings ratio. So there's two of those on this chart. The first is the second from the bottom. NTPM stands for next 12 months. The fourth from the bottom is TTM, which is trailing 12 months. And so the trailing 12 months PE looks at the earnings from the last 12 months from the S&P company and divides that into the price of the S&P, where the next 12 months looks at projections from Wall Street analysts and divides that into the current price of the S&P. So by either measure, stocks are expensive. So they're at the higher end of the historical range. I will note that PEs and the ratios that you look at, whether that's PE or the Shiller Cape, whatever it is, they're very sensitive to the time period you're in and what interest rates may be. So a lot of the data behind this goes back, beyond 1990 or before 1990, when you had a very different inflation and interest rate environment. Even so, even by modern standards, I would say that right now stocks are at the higher end of their valuation metrics. That said, there's a reason to believe if some of the companies that we have alluded to, if productivity gains within AI continue to impress to the upside, Potentially, you could see the stock market continue to churn higher, but it's certainly not the home run that we saw in maybe 2016 when Trump was first elected. I think you saw on the previous slide a 16 times price to earnings. That's just going to be a much better buy than at 22 times price to earnings. The other thing I'd note is that if we look at kind of the average stock within the S&P 500, the ratio is closer to 17, which is close to historical norm. And I think that's why even within the stock sector of our portfolio, client portfolios, we diversified much beyond just those top 10 names or so that make up 30% of the S&P 500, just because they're so richly valued at this point.
Yeah, so that's what I was going to comment on, Dax, is that if the stock market valuations are being driven primarily by tech and those 7 companies, there is potential for the rise of the rest, right?
Yeah, I think so. I think last year, if you look at the average stock, it was up 10%, but we're starting to see pockets. Jason alluded to utilities. They're certainly not in the tech sector, the Magnificent Seven. They're starting to do well, and that's going to enable any kind of productivity gains from technology is going to have to be powered by our utilities, right? And so that's one area. You started to see financials do better. Starting in July, real estate started to do better. So kind of looking forward or looking through the S&P 500, there's still some good deals to be had within the broader stock market here in the US, and not all companies have done well over the past couple of years. And we are thinking, maybe it is time for a rise of the rest, like you mentioned, Holly.
Yeah. Well, on that note, we're going to take it over to what I would find the most distressing slide of the entire conversation we're having today. Dax, talk us through the assumed 10-year outlook on this chart.
So now I do have to be the Grinch, Holly. So
I know.
yeah, so this is from BCA. They're another, research provider that we follow. And you can see that over the last 20 years, US stocks have produced about 11% return. So they're projecting out, about 3.2% for the next 10 to 15 years. I will say that this is probably one of the more bearish outlooks that we follow. And I think it's important as a data marker just to think about, we've had a really good run in US stocks. And there are reasons that we talked about in the previous section that we can continue to see US stocks remain highly profitable. I think the sector mix here in the US leans towards technology, which is a more profitable sector, but there's some execution risk involved in that. We saw that. I think you alluded to the NASDAQ dropping 70%, and that was during the tech bubble. So we saw how the creative destruction of capitalism could lead to, 4 straight 20 plus years in the late 90s. And then, if you don't follow through on the other side of that with productivity gains and profitability, you could see, the stocks drop quite a bit during that period. I don't think we're predicting anything like that. The technology companies that we're talking about do cash flow as opposed to some of those we saw in the late 90s. However, we have had such a good run. We're starting at such a high price point that, earnings have to come through on the other side. And to the extent that they don't, it's going to be a bumpy ride in US stocks. I think on the other side, though, there's some positives here. If you look at corporate bonds and US treasuries, if we're talking a decade ago, I bet you're looking at a 1% return for those. So especially for our retired clients where, 30 to 40% of the portfolio might be in bonds, they almost got no return in the last decade in those areas of their portfolio. We always like them because they're a defensive asset, and potentially if we do have a recession or something like that, they're an area where we can fund clients' cash flow. However, if you're looking at 4.5 to 5% yields now in some of these sectors of the bond market, that's kind of what we expect returns to be on the bond side of portfolios over the next 10 years. Interest rates explain about 90 to 95% of return in any bond. And finally, I think we've done a good job as an investment committee just doing due diligence and allocating more and more into private alternatives in our client portfolios, because that market has matured, whether it's private equity, private debt, or private real estate. And we still think there's opportunities within those markets that may not be subject to the quote unquote headline headwinds of the incoming administration or some of the geopolitical events that we're going to talk about later. And we think as a return enhancer and to reduce the risk in some portfolios, reduce the volatility, that's an area that we definitely consider for a lot of our clients.
Yeah, and I'll just point out on this chart that this is not a 60-40. It's more like a 50-50. And for many of our clients, we've really leaned in more on the alts, up to maybe 30% of the portfolio. So definitely the message here for our clients is we have a lot of wild cards and unknown factors, and the best way to hedge against that is to have a very well diversified portfolio and maintain a disciplined approach, not try to time the market, hop in, hop out, go to cash. That just rarely, if ever, works.
Yeah, and I was just going to add in, as Dax mentioned, anytime you're starting with high valuations, it would suggest that your forward returns are going to be lower than where they have been. He mentioned this is a more pessimistic projection from this particular research provider. But down at the bottom of the screen, there's a little red box that shows your real return above inflation. And for the past 20 years, a lot of folks have experienced a very healthy return above inflation. The projections from this slide would suggest that going forward, real return above inflation is going to be about half of what it had been. But I was going to point out that for most of our clients and for a lot of people, that 2%, 2.6% spread is still sufficient to help you meet your goals and help you achieve a healthy retirement. And so we obviously want to have those one-on-one, conversations or do those one-on-one financial projections for all of our clients when it makes sense to. It just means that that margin of safety may be a little squeezed in the projections relative to where they may have been a few years ago, but still gets you home on time, still gets you a nice margin of safety in your financial plans and financial projections. And so we do think that we've got a lot of tools across these different asset classes to help all of our clients kind of meet their objectives.
Absolutely. With that said, if you're having trouble sleeping at night and worried about this, please do reach out to your advisor. This would be the time to adjust your risk tolerance if you're concerned. Let's talk about inflation for a moment. We've had a lot of changes here in inflation in the last 2 years, going from a high of 9.1 down to where we are today at 2.9. Can you dig a little under the hood, Jason, and tell us what is driving that?
Yeah, so we're circling back to this theme. We brought it up a few times. We talked about how inflation has dropped so much over the past couple of years and is really at a long-term average level of just under 3%. But one of the risks we see this year and going forward is that there could be upward pressure on inflation again. We're not predicting that inflation is going to jump back up to 9% where it was coming out of COVID. That was a bit of a unique, supply chain snarls. You probably all remember the ships being stacked up on the ports over on the West Coast. But we are thinking that, if some of the policies that may come out of the new administration, other factors could put upward pressure on inflation going forward. What you see on the screen here, each of these different colored bars represent a different category or component that goes into the inflation calculation. And prior to COVID, coming into COVID, a lot of what drove inflation higher, that green, the orange, and the purple bars, were just stuff that we buy, just things that we purchase. Fuel for our cars, just normal core goods that we all have to buy for our households, the food we buy to cook dinner at our house. All of those costs skyrocketed tremendously over that period. The past couple of years, you can see there at the bottom of the screen, the green bars, the orange bars are actually detractors from inflation. They've actually come down in price and energy costs and some of those core goods. And what's kept inflation high, those dark blue and the light blue, those are more service-oriented measures of inflation. So things like eating out or going to different events. The dark blue is shelter or housing costs. All of those have remained very sticky these past few years, and may remain sticky going forward. Any kind of services inflation is much more difficult for the Federal Reserve to control simply with interest rates. And so as we go forward, if those items continue to put upward pressure on prices and price growth, that's going to really impact the way that the Federal Reserve manages their interest rate policy going forward. And that's going to have implications for the stock market. And so what might cause that to happen? I'll just talk through a couple of these. That first one, we mentioned different policies by the administration. Tariffs are the easiest one to see. Tariffs are a direct rise in prices, a direct price increase on goods. Most of that price increase gets borne by the companies that actually import the goods across the border. But all of those companies are going to do what they can to pass those costs on to the end consumer. And so that is a direct increase in prices. You could argue that maybe it's a one-time increase and not a continual ongoing percentage gain that gets continually compounded, but it's still a rise in prices that's going to push that inflation rate higher if tariffs are implemented anywhere near the magnitude that they've been proposed. We are hopeful that a lot of what's been proposed on the campaign trail over recent days are more talking points, hoping to bring up the other party to the table for discussion. But you can't rule out that perhaps tariffs could be implemented in a major way, and that could put upward pressure on prices. The other one I would point out is the housing side. The supply of housing in our country relative to our population growth over the last few decades is very low. And so as our population has grown, the demand for housing, people need to live somewhere, the demand for housing is very high, but the supply is not kept up. So economics would tell you that price has to rise in order to bring those two things into equilibrium or into balance. Over time, supply could rise. That could also bring that into balance, but price can adjust a lot faster than supply can. And so as we look forward, we do think it's very likely or probable that we'll continue to see strong rental growth rates and probably upward prices in the cost of housing. And so that, again, is going to get baked into the aggregate level of inflation in our system and is going to have some pretty meaningful implications for how the Federal Reserve shifts interest rates as they go forward. We've mentioned that they started cutting interest rates last year. Inflation didn't get quite as low as they had hoped it would. And now that it's been sticky and ticked up these last couple of months, they've been on hold. And they effectively said they're going to be on hold until they get some more data in and see what policies are actually implemented over the next couple of months. And so that's going to have implications for where interest rates fall going forward and how stocks get priced based on those interest rates.
Yeah, and I would love any one of you to talk about what might be a controversial topic, which is immigration policy, its impact on those sticky services, food, and whatnot. Any thoughts there?
I mean, I think if you lower the workforce in those areas, you're either going to replace them mostly with higher wage workers, or you're going to have to find other ways to accomplish the same, or we're just going to have less produce, less agriculture flowing into our markets, flowing into our grocery stores. And so all those things, you would think would be inflationary. And so again, it depends a lot on, with this immigration reform, how far does it go? And how much does it impact, again, those who are working to add value and to produce for our country, most of it, which the rest of us consume. And again, agriculture being a large piece of that.
Thank you. Well, let's talk a little bit, PJ, if you would, about interest rates. And I know the Fed's terminal rate was 2% for a long time. Has that changed?
So what we're looking at here is the world interest rate probability implied overnight rate for the U.S. futures model. A lot of words to really say what Holly just said. What's the Fed's terminal rate? And by terminal rate, we mean during this rate cycle, where does the Fed funds rate bottom out? How low does it get? And what you're seeing on this chart is what the market has that terminal rate to be over the last, call it, 6 months. And so you can see when they first started cutting rates last September, we were over 5%. The market expected that we're going to go all the way down to maybe 2.5% to 3%. What you saw the rest of the year, though, with how inflation played out, we saw the rise in inflation, continued strong job market. The Fed doesn't necessarily consider this, but they do know the data that DAX showed about the stretched valuations. And so now the market's expecting that we may bottom out in this cycle in that 3.75 to 4% range. Right now we're at 4.25 to 4.5%. So that would imply only 2 more rate cuts during this cycle. Coming into this year, or really probably around September of last year, most people expected multiple cuts in 2024, or 2025, I should say. Now, 1, maybe 2 is what's expected outside of a significant change in the direction of inflation, the strength of the economy. And so that's something that we're going to be watching closely. When you think back to, we started cutting in September, the Fed cut 1% via 3 rate cuts the rest of the year. What happened to interest rates? Well, short-term rates tracked the Fed rate cuts. They declined about 1% or so. But what we actually saw was that longer-term treasuries, 10-year treasuries, actually jumped maybe on the upwards of 1%. And so that might be counterintuitive what somebody would expect. When the Fed started cutting rates, they might think, interest rates are just going to decline. We haven't seen that in longer-term rates, and we haven't seen that in mortgage rates. Mortgage rates actually jumped back above 7% on the 30-year mortgage earlier in January. And so again, what does that mean? It means that here at Stearns, we probably think that rates might just be higher for longer in this rate cycle. And so again, as Dax alluded to, that might be an opportunity for investing in bonds because again, you're able to invest at higher levels than you were previously. And that kind of is a determinant in how the return is going to look for those bonds over the next 3, 5, maybe even 10 years.
Yeah, and I would just jump in and say, higher interest rates have a little bit of a mixed connotation. They're great if you're a saver, if you've got your high yield savings account, or you're using a money market fund for some of your excess cash in your brokerage account. That's great. You're earning great interest on that. But you think about the borrowing side of the economy, anyone that needs to borrow to buy a house, or you think about a small business that needs to take out a loan to expand operations or make those next capital expenditure payments, higher interest rates become a big headwind to their capital flow, to their cash flow. And so eventually that takes inertia out of the economy. And so the Fed is trying to get to a sweet spot, or sort of a level of interest rates where it's healthy for the economy to spur economic growth. And it just seems like the implication is if they have to keep rates higher, particularly if they end up having to raise rates at any point this year, that's going to have some negative consequences for stock prices in the short term, but also for cash flow for businesses going forward. And so it is a risk that rates are not able to come down to a reasonable level over these coming months.
Yeah, and that's a great segue into our next slide, which is we're at a heightened level of risk for political and geopolitical events right now. We generally say that they rarely impact markets, but we have a lot going on. And PJ, feel free to talk us through some of these items.
Yeah, and so the next couple slides we're going to touch on global debt, but on this slide, really looking at those driving U.S. policy. So again, that's the Department of Government Efficiency, and so their goal is to cut what they would say is excess fat. Hopefully, cut spending where they think it's not adding value. We've already seen some executive orders and some other proclamations that maybe might cut federal grants. You've seen maybe potential to cut federal employees that don't go back to the office 5 days a week. Again, these cuts, it's hard to see them being on the magnitude to fix the current budget deficit, which is approaching or past $2 trillion. But again, anything we can do to cut expenses to move towards that without offsetting it with revenue cuts would be a positive at this point. But again, Holly, I don't know if you want to touch on the populism.
Yeah, populism is a trend that we're seeing. It's not just in the US. A lot of the world, whether it's South America or Europe, is trending toward populism, which in the short term can often be a good thing. A lot of deregulation, give the people what they want. But over time, studies have shown that populist tendencies are actually a negative for economies because it basically is about consolidating power and dismantling systems of checks and balances, which obviously we need for people to believe in markets and believe in the honesty or integrity of systems. And so that is something that will have a longer term negative impact. Unfortunately, populist regimes generally last about double the length of non-populist ones. And so we'll see how this trend goes worldwide, but it's definitely a headwind and something to watch out for.
Yeah, it has the potential to change both economic and military alliances across the globe. And so again, how those different chess pieces play out over the coming years is something that we'll be watching closely. And those chess pieces, as they're played, they will affect geopolitical scenarios. So we named 4 here. There's a lot more that we could discuss, but Ukraine, the war has not come to an end yet. Trump at Davos during his video recording said that he believes that Ukraine's ready to make a deal, but doesn't know what Russia's planning to do. You'd have to expect at this point that a deal would require, for Russia, it would require that Ukraine cede the land that Russia's currently controlling to Russia. But the question is, what would Ukraine get for that? Would they be able to negotiate any type of NATO security measures or something else that would benefit Ukraine? And so that's TBD as to what might be able to end that war. In the Middle East, Israel and their fight with Hamas, they did agree to a ceasefire with some hostages being released in exchange for Palestinian prisoners in Israeli jails. And so that's progress. But really in the Middle East, thinking this year, looking at Iran and Saudi Arabia. Iran obviously has been weakened in the past year. What's happened in Syria, what's happened in Lebanon with Hezbollah. And so as a result of that, they are definitely in a state where they are at their weakest in many years. And so how they react to that is something to watch as they try to negotiate alliances, probably with Russia and China as well. But then Saudi Arabia. Saudi Arabia is having discussions to maybe normalize relations with Israel, which would be a step of progress in that region. But at the same time, They've also promised the U.S. or told the new administration told Trump that they are willing to invest hundreds of billions of dollars in the U.S. in some form. Trump appears willing to want that to happen. And so again, that could potentially steepen the relationship between U.S. and Saudi Arabia. And so TBD on what that really looks like and whether it really can come to fruition, but it's something that we'll be monitoring in terms of that region. Probably the biggest one we're thinking about, our biggest rival, the US's biggest rival right now, would be China, Taiwan. In terms of, it appears that Xi Jinping, the president of China, wants to do something with or in Taiwan sooner than previously expected, as soon as maybe the next couple of years. What would that look like? Would it just be a non-violent takeover of Taiwan? Would it involve boots on the ground, a military invasion of Taiwan? That is all unknown at this point, but it's something that the U.S. is watching closely. And the question is, under the current administration, how would we react to that? What would we do to defend Taiwan? Would we do anything with our military, or would we negotiate with China to get something for allowing them to take Taiwan? So again, that's something that we're watching closely. Again, Taiwan does a lot of semiconductor production, and so that is something that's key for having access to that market for both China and the U.S. for that matter. Cyber conflict is a very big deal. It's something that most of us don't see day to day, but it's ongoing constantly in terms of the U.S. government's in rivalry with other governments around the world, Russia, Iran, North Korea, China, etc. And cyber conflict's very dangerous, has the ability to kind of affect many systems in the U.S. Our financial system is subject to disruption. Public infrastructure, such as water treatment facilities, could be subject to disruption. And so it's something that is at the front of everybody's mind, but it's something you don't see on a day-to-day basis. And something I got to mention that's not on here is just ungoverned spaces. When we're thinking about power vacuums in Yemen and Syria, the Congo, what could happen in terms of the revitalization of terrorist networks that we saw in the last decade. It's something to watch closely. But the one that doesn't get a lot of talk because it's not a place we live is outer space. There are so many satellites flying around already in outer space, and who controls outer space right now really controls global communication. And so again, that's going to be an ongoing kind of battle that you don't see between the US and China, Russia, and other countries. And so it's just something to keep in mind that there's stuff going on that you can't see in outer space that is very important to the future of who's going to be in power.
Yeah, not to pile on, but this next chart shows that we're also in a world of debt, right? So we can call this sort of a postmodern pie chart, right?
It's not just us in the U.S. that's in a world of debt, but the U.S. does have a lot of debt, and we have the most debt in terms of absolute amount at $36 trillion and counting. It doesn't look like there's any end in sight to us taking on more debt, just with given how the government is spending versus how much revenue it's bringing in. If you look at what that dollar amount means relative to our GDP, it's above 120%. And the first time it passed 100% since World War II was back in 2013. So again, 120% and potentially rising is something that we need to be cognizant of. Nothing imminent in terms of thinking about how that might affect the US dollar as a reserve currency. That is a long way off if that is ever impacted. But it's just something we need to be cognizant of because to service that debt costs a lot of money. And this line here at the top shows how much we are paying in interest payments each year to service our debt. 2024, first time we topped $1 trillion. That was a 30% increase in 23. How much is $1 trillion? Well, that's more than we spend on any part of the government except for Social Security and Medicare. And so to spend that money on interest, that doesn't seem very productive for adding value to the lives of US citizens. And so that's something that needs to be reined in. At the bottom, you see how much does that interest payment represent as a percentage of our GDP. We have been here before, back in the late 80s, early 90s, we had really high interest rates. And we also had high national debt, which created that situation. Right now, we have relatively low interest rates relative to history, but we have so much debt that it's creeping back up towards that 4% level. And so it's something that we're going to need to kind of watch closely going forward and figure out ways to alter the trend and the direction of this. Jason mentioned, I think, that higher interest rates benefit some and they hurt others. Well, the U.S. is a perpetual borrower. It hurts us to be paying these higher interest rates. Some, and maybe some of us believe that a misstep that the U.S. made and Treasury Secretary Yellen made during COVID when rates were close to zero or zero in some cases was that we didn't extend our debt maturities out as far as we could. So take advantage of lower rates. We did a lot of rolling 6-month, 12-month T-bills at then low rates, but then they became high rates, and now you have to keep extending and rolling at higher rates. And so that has all built us to this part where we are spending, again, $1 trillion on just interest payments each year.
Yeah, so not a pretty picture, but we're still not in a crisis here, I don't think. Well, Dax, I'm going to let you close us out just because you're the optimist among the group, and we ended with a lot of bad news, and so we need to turn this around.
Yeah, I think if anything, the takeaway is that there's some good things within the economy and the market. There's some reasons to be optimistic, but there's certainly not the home runs that we saw maybe coming out of 2022 when stocks were down 18% and bonds were down double digits as well. That was a tough year to go through, but it did produce a lot of, I don't want to say obvious opportunity for investment, but more obvious than what you have now. So with the incoming administration, they're certainly looking to put it mildly, shake things up. And so that may increase the uncertainty level that for investors at this point. And I think what you said, we're going over projected returns is spot on, is for our clients, just looking at, what is the return that they actually need to meet their goals? And are they in a risk tolerance level where they are comfortable, where they can meet their goals and they can sleep well at night? I think it's a great time to reevaluate maybe some of the winners within the portfolio and trim those back to where, you're more comfortable with the risk level in your portfolio. But, we're never going to get rid of U.S. stocks, certainly, and some of those bigger tech names, because they are a driver of growth and long-term growth within our portfolios. It's just, are we right sizing that for the client situation and making sure that they're comfortable with the volatility there, and adding the diversification like we had in 2022 to make sure that we can meet the spending goals of our clients as well is super important at this juncture in the market.
Well, thank you all, gentlemen, for joining us. And as a final closing thought for our clients, please don't hesitate to reach out to your advisor with any specific concerns or issues. We have a one-size-fits-one policy when it comes to your financial planning, and would love to help you through any concerns you might have. Thanks for joining us.